Today we're going to take a look at some of the worst when it comes to high-yielding dividend investments. These are investments that currently offer very high and attractive yields, but I don't believe anyone should ever consider holding them as long-term investments. It doesn't matter how discounted they are or how much they might pay in dividends. All of these companies have shown to have fundamental issues and therefore have struggled for most, if not all of their entire existences. All of these investments I've been asked to review at one point or another because of their extremely high yields. So I figured it would be a good idea to take a look at some of the most popular ones today. As I've shown a few times in the past, even if a stock falls massively in share price over time, it can still be a profitable investment if you reinvest the dividends. A good example of this would be the Cornerstone Strategic Value Fund, ticker CLM. Despite collapsing in share price over time, CLM has provided an average annual return of 5.91% since 1995. It sounds impossible, but CLM has regularly offered a yield of over 20% at times. It goes to show that a high-yielding investment can offer positive returns with long-term share price declines. But the stocks we're going to look at today have not provided a profitable return since their IPOs. And sometimes people will say, okay, this company suffered in the past, but there's some reason to believe that it's going to get better for them now. And when I hear that, I understand the appeal of wanting to get in on a heavily discounted company. And you could likely see some kind of short-term gains on these stocks. But I would not recommend anyone invest in any of these with the goal of retiring off of them because of their long history of poor performance. So with that being said, let's go ahead and get started. The first company I definitely would not recommend is Granite Point Mortgage Trust, ticker GPMT. This company originates, invests in, and manages senior floating rate commercial mortgage loans and other debt and debt-like commercial real estate investments in the US. This company provides intermediate-term bridge and transitional financing for various purposes, including acquisitions, recapitalizations, and refinancing. With a dividend yield of over 19%, I've received comments from people asking about whether this is a good investment for the dividend income or not. But there's a couple reasons why people should pass on this investment. Granite Point is a very small company. They're currently the 7th smallest M-REIT with a market cap of just $155 million. For comparison, Stewart Property Trust has a market cap of $6.11 billion. If you're looking for a sturdier dividend, it's always better to invest in the larger REITs because it takes less non-accruals or vacant properties to put the dividend at risk. And Granite Point has been suffering with one of the worst mortgage portfolios in the industry. On their latest earnings call, their CFO announced that they had $690 million worth of loans that they weren't receiving interest on, and 5 additional loans were placed on non-accrual status as of March 31st. Now, when interest rates do get cut, then I think that will greatly benefit this company. They do hold 98% floating rate debt, and with lower rates, their borrowers shouldn't be as hard-pressed to pay them, hopefully. But people should consider if it's worth investing in such a small company in such a risky asset class. I've discussed many times in the past that most mortgage REITs are not good long-term investments. There are a handful of good ones that do exist, but the majority of them lose a lot of value and experience dividend cuts over time. If you want to go ahead and hold some M-REITs, then there's a number of them that exist that have much better track records and that haven't fallen as hard as this company has. Another company with a terrible track record is Great Elm Capital Corporation, ticker GECC. They're a business development company that specializes in loans and middle market investments. According to their website, they invest in income-generating debt and equity investments that have an emphasis on specialty finance companies that provide exposure to a bespoke investment product that can outperform the liquid credit markets. With a dividend yield of almost 14%, I get questions about this company on a pretty regular basis, although not as much as I used to since they no longer pay monthly dividends. Since the beginning of this company's existence, it's been fighting a downward struggle. In less than 8 years, their stock share price has collapsed by more than 85%. This is shockingly bad performance in an asset class that doesn't normally experience these kinds of failures. On their website, they have a section called Why Invest, and the first thing they mention is that they have a sustainable dividend. But if we actually look at their dividend history, we can see they've gone through some pretty serious dividend cuts over the last few years. Great Elm went from paying $1.47 each quarter to just 35 cents a quarter today. A major issue for this company has been its collapsing net asset value, which has been one of the worst in the BDC sector. Today they have stabilized a bit and conditions are improving for them. But I have to ask, why should anyone bother investing in this BDC when there's a ton of greater options out there? It is rare to come across a BDC that yields almost 14%, but if you're willing to settle for just a couple percentage points lower, you won't have to entrust your money with this kind of management team. As of last quarter, their dividend payout ratio was 94.5%. This is pretty high for right now, and many BDCs out there are seeing better coverage and are still paying special dividends. I can't possibly think of a great reason to hold this company when there's so many better performing options out there. Just like Granite Point, Great Elm is also a pretty small company, which is another negative for them. Check out Blue Owl Capital, Hercules Capital, or Ares Capital, just to name a few. Another company that people should continue to avoid is Orchid Island Capital, ticker ORC. They're a specialty finance company that invests in residential mortgage-backed securities on a leveraged basis. Their RMBSs are backed by single-family residential mortgage loans, referred to as agency RMBSs. Its portfolio includes traditional pass-through agency RMBSs, such as mortgage pass-through certificates and collateralized loan obligations. They claim their objective is to provide attractive risk-adjusted total returns over the long term through a combination of capital appreciation and the payment of regular monthly distributions. ORC currently offers a yield of almost 17%, and they actually do pay monthly dividends. There are a lot of people out there who only pay attention to those two things, and they will jump right into this stock. It's actually a very common stock among first-time income investors, but Orchid Island has not been a good investment at nearly any time since its IPO. Just like every other company we've looked at up to this point, they've gone through a serious amount of share price destruction. In 2022, the company did a reverse stock split in order to increase their share price since it was basically a penny stock at the time. I have seen comments from people online who have this mentality where they'll say to themselves, I'm 80 years old and capital appreciation isn't too important for me, I just want to reach for the highest dividend I possibly can. But ORC also continues to have one of the worst track records of any REIT in terms of dividends, going through about 8 cuts in the last decade. It's been about 6 months since I last took a serious in-depth look into this company, and things have only gotten worse for them. You can see their net income in Q1 fell by 26.9% compared to the previous quarter, and their stock is now at risk again of another dividend cut. Right now they have a payout ratio of 94.7%, and many people are confused about how this could be possible. Here you have a company that invests in government-backed mortgages that are guaranteed. How on earth could you lose money doing something like that? It's a topic that's way too long to get into in this video, but I did cover it in this video if you happen to be interested in the topic. It all comes down to how much they earn from the mortgage interest and the borrowing costs to buy the mortgage, plus a lot of leverage is involved. But it looks like nothing has really changed at Orchid Island since our last check-in. It's just a bad company that everyone should stay away from. So in summary, all of these stocks I'd consider to be among the absolute worst places to put your money if you're looking for income. Don't pursue yields too aggressively, and instead look for holdings that offer yields well within the average range for them. Every time I talk about these investments, I always get some people who say they have earned a positive return from them, but they either just bought the shares like a month or two ago, or they were very, very lucky. But even if market conditions improve, I still wouldn't suggest investing in any of these companies. Let me know your thoughts, but with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.